Hello and welcome to yet another video. This one is going to be longer. The title is Eye of the Storm, and it of course talks about the stock market. My goal with these quick videos is to prepare you as briefly as possible for the days, this time for the weeks ahead. Remember that the daily analysis form the basis, so subscribe for free on my site. As for Twitter feed and Telegram channel, enjoy timely notifications and two-way discussions with me. Thank you for liking, subscribing and commenting on this YouTube channel of mine. It does really help. Thank you. So, let's dive into stocks. The big picture is one of an upcoming recession. And let me present the most punchy signs pointing towards this outcome quite unequivocally. Money supply growth, after a brief reprieve starting in, say, October, November, coinciding with the prior stock market bottom, has turned negative again. LEIs have been declining since December last year, and typically the lead time to recession having started is 10 months. As for yield curve inversion, that happened at the start of summer last year, and the typical lead time is around 19 months. But when it comes to yield curve inversion, that's not the most precise indicator. LEIs are more reliable in this respect. So why aren't we in a recession already? Is the excess savings from the pandemic era that have been cushioning the consumer? That's why retail sales haven't been dropping. That's why there hasn't been an earnings apocalypse in Q2 already. Remember that the Fed is still tight, whether it is raising rates or shrinking its balance sheet as much as circumstances, meaning the debt ceiling and so on, allow. Do we get any fresh stimulus this year? Most probably not. On the contrary, we are going to see the Treasury Department replenishing its general account at the Fed, and this will be sucking out liquidity. So where would it come from? Either from reverse repos or from bank reserves. And I'm of the opinion that bank reserves would be hit as well. And historically there is quite some fine correlation with the delta, the move in bank reserves to the move in stock market in general. And reverse repo facility wouldn't be enough to balance what Treasury needs to get. Bank lending standards are tight already, and it's affecting both households and the corporate sector. Credit card debt is rising, and even though it's not a problem right now, and overall household debt levels are quite serviceable, it will prove an issue with passing time in the quarters ahead. Quite unmistakably, tax collection is down, bankruptcies are sharply up, and these are not signs of a strong and strengthening economy. In my view, there is no mistake in arguing that soft landing or no landing would happen. It won't. The case for a recession, however mild it would be, is overwhelmingly stronger. And last two indicators pointing towards Q3 recession are job market indicators, the leading ones, meaning overtime, temporary workers, hours worked. These are pointing south already for quite a while. Unemployment claims have been catching up since April, as I have been anticipating. And when it comes to the stock market, there is the argument that the narrow and vulnerable breadth would get broadened sufficiently enough to carry stocks into a new bull market, which I frankly don't see it like this. The situation is reminding me of the post-dot-com bubble situation, where market breadth has been also improving, creating basis for this false argument, and stocks yet again declined and spent quite some time going back and forth within that 2000 to 2002 bear market. Consider these factors. Can really a bull market start before recession even starts? I don't think so. Have we seen a catalyst for either panic, blood in the streets moment, or turn around when you buy everything inside? Neither. Can a bull market start before the Fed pivots? Can it start before the Fed goes dovish? No, I disagree. Alternatively, is a fiscal stimulus manifesting to make up for lack of a dovish Fed? No, there is still a long way to elections. So I don't think that any knight on a white horse would appear this summer. Remember that the world's central banks are still in a tightening mode because of the really stubborn core inflation figures. And as a consequence, and it will affect tech, of course, as well, corporate profits, operating margins, free cash flow, revenues, all the financial metrics would decline again in quarter 3. And of course it would be reflected in both PE, that's valuations, and E, earnings, as I have said. So let's dive into the very short-term picture. We see stocks declining for quite a few days in a row, and I doubt this is a correction only. The intraday spikes, be it Thursday or Friday, get sold into quite fast. They don't last more than a couple of hours. And any kind of rotations, be it out of the former strong leaders, such as tech, communications, discretionaries, it's not enough to lift either the former laggards, or when it comes to rotation back into tech, it's not enough to lift the whole index and make up for weaknesses elsewhere. You may argue that utilities should be rising in a risk-off setup. But remember that markets are getting accustomed to Fed keeping rates restrictive, however slightly it defines them to be restrictive, for longer than the market anticipated. So all the durations from 10 years to longer are reflecting that in higher yields. And this is hurting utilities. That's why they cannot catch such a solid bid as it would have been the case otherwise. So, for full-fledged fireworks, we need to see retail Russell 2000 and transportation to decline from their still quite high perched levels of today, and that would provide a clear answer to the question whether this is just a correction or a reversal slowly but certainly underway. So the key levels for Monday is 4,415, representing now resistance that would be quite tough to break, and keep above, not just break intraday somewhat somehow, but to keep above on solid breath. For 385, I don't see many issues there with this level holding up, and we would be faster or slower grinding towards 360s, and it would happen ideally by Monday's close or Tuesdays, perhaps Tuesday's mid-session. One more slide covers market breadth, the percentage of stocks trading above their 50-day moving averages. And here you see that on Friday tech really improved, but it was not enough to lift either the stock market as such or the market breadth of non-tech companies, meaning that the rotations have been barely there. They are not kicking in. Just watch my previous video from Friday that is on the topic of failing ES rotations. And what I would look for is the green light for ES decline starting really in a more straightforward one-way fashion. Apple and Facebook declining. That would be the key, because these are for now still the stronger ones, not characterized by Nvidia style P ratios that I would like to see somehow hesitating as a bare minimum. This chart also shows that the prior improvements in market breadth in non-tech have been pretty fast erased. Just as fast they appeared, that fast they went away. And if you look at the advanced decline line, minus 1,115, that's quite a solid embedded downtrend reading. And while it somehow would likely end up better on Monday, maybe around minus 500, give or take a few hundreds, it would still not be enough for a reversal. So, by now you must be familiar with my daily analysis published on my site every single trading day. You know me certainly from Twitter and from Telegram. Remember that Telegram serves the purpose of delivering you timely, reliable notifications every single time I tweet, and I tweet a lot during all the day. Site terms apply, links you have there. Beware of imposters, of course. And if you know me or don't know me, get familiar with my journey to trading and financial world. Obligatory disclaimer: